Welcome to today's podcast. My name's Andrew Wilkinson at Interactive Brokers. Now, global government bond prices have fallen sharply in the wake of the turmoil brought about by a muddled tariff policy from the Trump administration. That means that the cost of borrowing has risen for governments at a time when the global economy could be heading into at least a slowdown, if not a full-blown recession. Here to discuss is Michel Sommer, electronic bond trader from Interactive Brokers. How are you, Michael?
I'm doing very well. Thank you so much.
Tell us where you see the US bond market right now.
Well, right now we're in a period of quite a lot of volatility. As you stated regarding the Trump policies, the U.S. policies with tariffs and the latest comments over the weekend about relieving Powell from the Treasury has caused quite the stir in markets, and they're reacting. Every time there's a policy change or statement that comes from the White House, we tend to see a big move. 10 years currently at about a 436 with a very steep curve, the steepest we've seen in a while. If you go back to the 7th, we saw a 70 basis point move in the 10-year from a 385 up to a 458 in just a week. And then we saw the reversal in 3 days back down to a 426. This morning, we've seen buying in the front end of the bond curve with outflows in the long end, causing the curve to steepen even more. With the increased rhetoric over the weekend regarding Chairman Powell, it's left investors and traders exhausted, and we're waiting to see news coming out of the White House.
If President Trump managed to persuade the Fed to cut interest rates almost in an emergency fashion, that might even have a dire effect on the bond market. That might even send 10 years upwards, long notes and bonds yields higher, and that would be seen as a bit of a shot in the foot, wouldn't it, Mike?
It would, yeah, because basically what we would see is the pressure to the Fed to drop rates sooner than they really state that they want to would really call into question whether the central bank and the Fed really has independence from the presidential administration. And it would politicize everything, and it would just cause the whole world to lose confidence in the U.S. as one of the market leaders in the safe haven.
What do you think the bond market is telling us currently about the future health of the US economy?
Well, we're on edge. Investors are on edge. Again, statements out of the White House. We just had a statement from President Trump that Jerome Powell's termination cannot come fast enough, right? Again, that's put us on edge, and it's really pushing the indication that the central bank doesn't have its independence, right? And if the central bank doesn't have its independence, again, it's politicizing the whole system here. And we'd see, as we do in a lot of emerging market countries, a very steep curve.
How about US government debt performance relative to debt from other governments? How's the US performing? What are spreads doing?
We'll start off by saying that U.S. treasuries, along with gold and the U.S. dollar, have historically been considered a safe haven. So typically in times of turbulence, you see investors come in and buy U.S. treasuries, gold, invest in dollar. But what we've seen, because it's really the U.S. policies that have caused some of this turbulence, real money and fast money investors have been deleveraging. They've been taking money out, and it hasn't been like the world, such as China, just unloading all their positions, but we've seen the leveraging and people putting money into European governments, securities, right? So that being said, spreads between U.S. and European governments have moved significantly in both directions as policy comments come out of the White House. So we've seen whipsaws in the rates.
So, Michael, some commentators are noting the possible end of what's been called US exceptionalism. How important is that for US debt and the US dollar, in your opinion?
It's very important. We can't take for granted that the world has historically looked at the U.S. as a global leader and a safe haven. So if the world loses confidence in the U.S., which we're seeing the early stages of, we'll see the dollar continuing to weaken and the steepening of the bond curve. We've already started to see the euro dollar move. We had a 14 big figure move since January. and it's levels we haven't seen since 2022. If uncertainty in the U.S. continues, we'll see a continued sell-off in the long end of the U.S. debt, which will push U.S. interest rates higher, and ultimately we'll see a spike in inflation.
People have referred to the Fed put when it comes to the scale of falling equity prices. The theory is that if stock prices fall so far, the Fed will step in and they'll cut interest rates because the economy's going to hell in a handbasket. Recently, we heard the term Trump put mentioned when the yield on the 10-year US note reached about 4.5% in the last couple of weeks. Could you explain the concept of the Trump put and why this is important from a policy setting perspective?
Absolutely. So the Trump put's very similar to that of the Fed put. President Trump's very cognizant of U.S. markets and how they're performing. So when markets reach uncomfortable levels, Trump dials back his tariff policy to ease concerns and allow markets to settle down. Trump ultimately wants a weaker dollar and a more favorable trading environment, if you will. So he wants to bring manufacturing jobs back to the U.S. But if he pushes his agenda too hard and quickly, he causes a whipsaw in global markets. So basically, the Trump put, when these markets reach that uncomfortable level like they did within 10-year hit 450, he dialed back on his policies to allow the market to take a breather and settle down and calm the market.
That's a bit of a dangerous policy stance, though, isn't it?
I would think so, right? If you have small incremental moves versus rapid whipsaws, it's better for the global economy and the U.S. as a whole.
Michel Sommer from our voice broker desk on the electronic bond side, thank you very much for joining me today.
My pleasure. Thank you.
And if you enjoyed today's podcast, don't forget to subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. U.S. spot gold trading through IBLLC accounts is only available to legal residents of the United States that do not reside in Arizona, Montana, New Hampshire, and Rhode Island.